Last time, we followed the digital dollar and found that the dollars inside your apps are private promises issued by two companies riding on a new set of financial rails. But stablecoins only put the dollar on those rails first, because right now, the biggest names in finance are moving their own assets onto the very same rails. Not just the dollar, treasuries, money market funds, bonds, and increasingly, shares of stock. The largest asset manager on Earth runs a fund that lives on a public blockchain. A mutual fund exists whose ownership record, its official share register, is itself a blockchain. A major Wall Street bank has issued a dollar token on a public network. And the quiet utility that clears almost every stock trade in America has begun moving real tokenized securities into live trading. It is called tokenization, and it raises the question this whole series has been walking toward. What happens when Wall Street's own assets move onto these rails? And who controls the pipes that everything then runs on? That is not a prophecy, and it is not a pitch. So today, we do the calm thing. We explain what tokenization actually is, who is really doing it, what it genuinely changes, what it genuinely risks, and the quiet question of power sitting underneath it all. Because the answer to who controls the pipes turns out to have very few, very familiar names.
So start with the one idea that makes everything else clear. When people hear that a bond or a fund has been tokenized, they picture the asset itself somehow teleporting onto the internet, leaving the old system behind. That is not what happens. A tokenized asset is two things at once. There is the token, a programmable entry on a blockchain, which can move anywhere on Earth around the clock in seconds. And there is the actual asset, the Treasury bill, the fund share, the stock, which still sits exactly where it always did, in a vault with a custodian inside the traditional financial system. What ties the two together is a legal contract, a wrapper that says the person holding the token is the true owner of the asset behind it. So the token is not the asset. The token is a fast, programmable claim ticket on an asset that stays in the old system. Take the fund that made this mainstream, BlackRock's tokenized money fund. The token lives on a public blockchain, but the cash and the treasuries behind it are held by a custodian bank, the Bank of New York Mellon. And a separate firm called Securities is the registered transfer agent that actually issues and records the tokens. So the futuristic token sits on top of a very traditional stack of custodians and lawyers. And this is the load-bearing idea. So let me say it plainly. A tokenized asset is only ever as good as two things: the custodian actually holding the real asset and the legal wrapper binding the token to it. Tokenization does not remove the middleman. It puts a fast, programmable claim on top of him. And if that sounds familiar, it should. Last time, your app dollars were a claim on a company you could not see. This time, your tokenized asset is a claim on an asset you cannot see, held off-chain by a custodian under a contract. So who is actually doing this? Here is the part that surprises people most. It is not crypto startups. It is the incumbents. Start with BlackRock, the largest asset manager in the world. In 2024, it launched a tokenized fund holding cash and short-term US treasuries. And by March 2025, that fund had crossed $1 billion. The moment tokenization stopped looking like an experiment and started looking like a market. It was the pioneer. Though treat this as dated, by 2026, it was no longer the single largest of its kind. A rival had edged past it, and the leaderboard shifts month to month. Then there is Franklin Templeton, earlier still. Back in 2021, it launched the first US-registered mutual fund to record its share ownership on a public blockchain. The official list of who owns the fund is the chain itself. There is JPMorgan, whose blockchain platform Kinexys has processed trillions of dollars, and which in late 2025 became the first major bank to issue a dollar token on a public blockchain. And the most telling name of all, DTCC, the quiet utility that clears almost every securities trade in the United States. In July 2026, it moved tokenized stocks, funds, and treasuries into live production trading, alongside BlackRock, JPMorgan, Goldman Sachs, and Vanguard. Add the exchanges building their own rails,
the London Stock Exchange Group, and NASDAQ, and 8 central banks testing shared settlement through the Bank for International Settlements. This is not the fringe. This is the core of the system. Now, the honest scale, and treat these as dated. By industry trackers, as of 2026, tokenized U.S. Treasuries add up to only around $15 to $16 billion, and the whole market of tokenized real-world assets is somewhere around $30 billion. That is tiny, a rounding error next to the several hundred billion in stablecoins. The direction is real. The size is early. Both are true.
So what does all this actually change? The clearest answer is settlement, the invisible step that turns out to be the real prize. When you buy a stock today, the trade does not truly finish the instant you click. In the United States, it settles 1 business day later, a standard the industry calls T+1, tightened from 2 days only in May 2024. For that day in between, the deal is agreed but not final, and a whole layer of the system exists to manage the risk that one side fails to deliver before the clock runs out. Tokenization promises something different: atomic settlement. Because the asset and the cash can both be tokens on the same shared ledger, they can swap in the very same instant, in a single transaction. The asset moves only if the cash moves, what the industry calls delivery versus payment. Either both legs happen together, or neither happens at all. That collapses T+1 toward instant, and closes the window where one side could fail. That is the genuine mechanical upgrade, and a big part of why the incumbents are paying attention. But here is the honest caveat. Faster is not automatically safer. Settling in an instant means both sides must have the cash and the asset ready at the very same moment. You cannot settle now on money that arrives tomorrow. That requirement, called pre-funding, carries its own costs. And the risk does not vanish. It moves. The International Monetary Fund put it plainly this year. Tokenization can lower the risk that a counterparty fails, but it shifts risk into the code and the infrastructure running the new rails. Faster and differently risky. Not faster, therefore safe. Hold that phrase, because it is the fair way to read everything that follows.
So let us state the upside, plainly and fairly, because it is real. Markets that never close. A token can move at any hour, any day, weekends included. Speed and simplicity. Value moving as easily as a message, with fewer intermediaries each taking a cut. Collateral that moves like software. Shifting a treasury to post as collateral can take a day today. Tokenized? It can move in minutes. So firms can fund themselves and manage risk in close to real time. DTCC and JPMorgan have both demonstrated exactly that, live. Fractional access. A token can be divided very finely, so assets that once required large minimums, funds, private credit, perhaps one day real estate, could in principle be held in smaller pieces. And programmability. Because the token is code, rules can be built into the asset itself, a bond that pays its own interest, compliance checks that run on their own. Supporters argue this is actually more transparent than today's opaque back-office plumbing, because the ledger is shared and visible. You can see why the biggest institutions are moving in, not out of hype, but because the machinery is genuinely faster, cheaper, and more flexible. Now, the honest caveat. The same discipline as last time. Most of this is still early. A large share of the tokenized market is not actively traded at all. It is bought and then simply held. One report in 2026 put it bluntly. Most of the tokenized asset market simply isn't moving yet. The capability is real. The everyday, at-scale use is still being built. That is the case for tokenization, stated fairly. Now, the other side, stated just as fairly.
Because the same design that makes tokenization powerful also creates new places for it to break, and an honest account names them. Start with the seam we opened earlier. The token can be flawless on the blockchain and still be impaired if the custodian holding the real asset mismanages it,
or if the legal wrapper binding the token to the asset turns out to be weak. A perfect ledger cannot fix a broken promise off-chain. The token is only ever as good as the custody and the contract behind it. Next, the risk that moves rather than disappears. The International Monetary Fund's central warning is exactly this. As tokenization scales, risk relocates. It moves away from bank balance sheets, where regulators have spent a century learning to watch it, and toward market infrastructure providers and the smart contracts running the platforms. A bug in the code, an outage on a chain, a flaw in a single platform, these become system-wide questions in a way they were not before. Not necessarily more risk, but risk in new, less familiar places, watched by fewer eyes. Then there is liquidity. A token is only as tradable as its market, and much of this market sits idle. In a moment of stress, thin liquidity can mean you cannot sell the token anywhere near its stated value, even if the asset behind it is perfectly sound. And finally, the question this whole video has been building toward: concentration. The rails everything runs on are consolidating into a very short list of hands. Now, none of this is a verdict. Supporters will tell you that regulated custodians and audited platforms are exactly what makes this trustworthy at scale, and that a shared, visible ledger is safer than the patchwork it replaces. Both cases are argued sincerely by serious institutions. The point is not that tokenization is fragile. It is that it is differently risky, and that the risk has moved somewhere new.
So, who controls the pipes? Follow the rails to their controllers, and a short, familiar list appears. First, the post-trade utility, DTCC, which sits behind almost every securities trade in America and aims to make nearly 1.5 million securities in its custody eligible for the blockchain. Upgrade that one pipe, and you upgrade the entire US market, but it remains a single, systemically central node. Second, the platforms. A firm like Securities is registered as a transfer agent, a broker-dealer, and a trading venue all at once, so it can control a tokenized security's whole life, from creation to trading to servicing. A new kind of choke point most investors have never heard of. Third, the chains and custodians. Most tokenized assets live on one blockchain, Ethereum, while the real assets sit with a handful of custodians, like the Bank of New York Mellon. Control the chain and the custody, and you control settlement itself. And fourth, the issuers, and ultimately the central banks. The biggest issuer is BlackRock, and at the center wait the central banks, whose blueprint places tokenized public money at the heart of the system. Now hold this next to where the series began. Last time, the dollar's digital form was not nationalized. It was privatized, handed to a few firms. This time, the rest of Wall Street's assets are moving on to rails a similarly short list of incumbents will run. The same pattern, one layer up. The plumbing of finance is being rebuilt, faster, programmable, and more concentrated. And the oldest rule of markets still holds. Whoever controls the rails controls the market that runs on them.
So where does the law stand? Reported plainly as policy. In Europe, a framework called the DLT pilot regime has been enforced since 2023, a supervised sandbox letting market infrastructures issue, trade, and settle tokenized stocks and bonds under real rules. In the United States, the securities regulator has a clear position. A tokenized security is still a security. Putting a stock on a blockchain does not change what it legally is. There is also a market structure bill moving through Congress, often called the Clarity Act, which would divide oversight of digital assets between the two main financial regulators. But note this carefully. As of 2026, it is a bill in progress. It passed the House and is advancing in the Senate. It is not yet law. And at the level of central banks, the Bank for International Settlements has published a blueprint it calls a unified ledger. Tokenized central bank money, tokenized deposits, and tokenized assets, all on one shared platform. Underneath the law sits the real unsettled debate. On one side, the efficiency case. Atomic, around-the-clock settlement and mobile collateral make markets faster, cheaper, and more open. On the other, the fragility case.
the International Monetary Fund's warning that risk concentrates in code and infrastructure, and the Bank for International Settlements' argument that tokenized assets should ultimately settle against public central bank money to stay sound. As for how big this becomes, serious forecasters disagree wildly. Some estimate the market could reach around $2 trillion by the end of the decade. Others say 16 trillion. Others as much as 30 trillion. When professional estimates span that far apart, the honest signal is the disagreement itself, mostly an argument about what even counts. We are not here to pick a number or side. We are here so you can see the machine and hold both cases at once.
So, pull it together. What happens when Wall Street's own assets move onto these rails? They do not disappear into the internet. Each one becomes two things at once: a fast, programmable token on a blockchain, and the very same old asset, still sitting in a vault with a custodian under a contract. Tokenization speeds up the claim and leaves the asset where it was. That is exactly why it is powerful. Trades that can settle in an instant, markets that never close, collateral that moves like a message. And it is exactly why it is double-edged. The token is only as good as the custodian and the code, and the risk moves out of the banks and into infrastructure the public cannot see. And who controls the pipes? A short, familiar list: the utility that clears almost every US trade, a few tokenization platforms, the dominant blockchains, the big custodians, the largest asset manager on Earth, and waiting at the center, the central banks. Whether that makes markets faster and fairer or more concentrated and fragile is a real unsettled argument between serious institutions, not something anyone can honestly predict for you. What you can know is the plumbing. So the next time you own a fund or a bond or a share of stock, you can ask the question this whole series has been building toward. Not just whose promise is this, but whose pipes does it run on? One note as always: this has been educational analysis of how financial market structure and public policy work, not investment, financial, or trading advice, and not a prediction. Nothing here is a recommendation to buy, sell, hold, or avoid any asset, token, fund, or platform. The figures are dated and drawn from primary sources as of 2026. Verify the current numbers before relying on them. And that leaves one last thread. Because once your assets live on these rails, the rails do not just move value, they can give it rules. Money and assets that can be told where they may and may not be spent. Frozen in an instant. Set to expire on a date. Conditions written directly into the asset itself, in code. So who gets to write those rules? And what does money become when it can be programmed to say no? That is where we follow the money next. This has been Money and Power Explained. Follow the money. It always leads to power.